What's up everyone, my name's Robbie, this is Robbie Manila, and today we're talking about how I use both fundamental analysis and technical analysis to find stocks. So usually I, at the very least, have bullet points about what I'm going to talk about in the video. Today I have nothing, like I'm shooting from the hip, so we'll see what happens in this video. Could be a train wreck, could be really good. You tell me what you think. So what we're doing today is I'm telling you about technical analysis, fundamental analysis, how I'm kind of blending the two together. And what I wanted to discuss with you is that I started my investment journey, I started learning about this, and I was a very strict value investor. So I thought Benjamin Graham and Warren Buffett were the two people who I looked up to the most. I still do. I still think they're amazing. Everything they've written is amazing. The way they think, the way they teach is amazing. But I've also expanded more out of just looking at those types of value investing ideas and also blending like technical analysis in there as well, because I do think that has a role, for finding when to buy a stock basically. And the way I kind of like came around into this way of thinking was when I started as a digital consultant for the company I work for here in the Philippines, which is an online brokerage, so online stock broker, which I've never actually mentioned on the channel before, but I am a consultant to a online stock brokerage here in the country. And what I do a lot of times is we deal with both the technical analysis, so the reports, and then we deal with fundamental analysis. So we kind of like have these two different arms, and there's always interesting things in both of those types of analysis. So as time has gone on and I've learned more and more about technical analysis, I've kind of blended it into this idea of finding stocks to buy. So anyway, what I wanted to do in this video is I want to show you kind of like just the process I go through. Going from finding a stock using fundamentals first to then looking at it technically as well. So that's what we're going to do. I hope you're ready. Let's go ahead and let's get started. Okay, so when it comes to fundamentals versus technicals, here's kind of how I do it. So there are some people who trade stocks. That's not what I do. So I do use technicals, but I don't use them to just trade stocks. I use them to find entry points into stocks I like fundamentally. Now, what does that mean? So you might not even know what fundamentals are. You might not know what technicals are. So doing fundamental analysis is essentially looking inside these different financial statements of a company, and technically, if you do technical analysis, it's just looking at the charts of the company. So it's really just analyzing the price moves of a company. So at the end of the day, I'm really looking for companies that are fundamentally good, that are selling at a good price. Now there's all different ways to kind of figure out if that is a good price that the stock is selling for. But the main way is to do something called a discounted cash flow analysis, where basically you take the company's cash flows and you extrapolate them into the future at a growth rate that's appropriate, and you see what all of those future cash flows are worth in today's dollars. That's basically the general way of figuring out if a stock is overvalued or undervalued, in my opinion. That's the way I would like to do it. So that's all fundamental analysis. The other part of this is once I figure out if a company is worth buying, if it's a good company, if I like what I see fundamentally, then I look at technicals. And so I look at technicals to see if the company that I do like fundamentally is actually set up for a good time to actually purchase the stock. Now, this goes against a lot of value investing principles. Value investors oftentimes just say that a stock is worth this much and it's trading for this much, so I'm going to buy it. I don't care what's going on in the chart. Now, I think that's absolutely, completely fine, and that's exactly what I used to think. But these days, I like to find a stock that's selling for this much, that's worth this much, but that also technically looks good. So that's the big difference. And maybe it's not that big of a difference, and it's not a huge problem if you don't do the technical analysis on it to figure that out. So let's go look at a company fundamentally first, and then let's look at it technically and see what we can derive from that. So the company I'm going to use today is Alphabet, so Google. And right now I'm on something called quickfs.net. So what's cool about quickfs is you could just see the pretty quick 10-year median margin. So gross profit 60.67. So that's a great gross profit margin. Of course, Google is a tech company, so it doesn't have huge expenditures, right? EBIT being earnings before interest and taxes of 25.9%. Free cash flow of 21.9%. And so that right there is a big thing that I'm looking at oftentimes is what's the free cash flow growth rate. So what we want to do now is basically if I would look at this and I'd say, okay, fundamentally I like Google. I think it's a great company. It's growing its revenues, it's growing its earnings, great cash flows that it's growing. So fundamentally speaking, I already know that I think Google's a great company. So what I would do now is I'd say, it's a great company, but is it worth what it's selling for? Because although it might be a great company, it doesn't mean it's a good price to buy. So what then I'll do is I'll go over to Guru Focus here, and I'm going to type in Google. The first thing I'm doing is I'm just going over to something called the DCF calculator, the discounted cash flow. So I want to see what a discounted cash flow, quick and easy, quick and dirty, DCF does for the price of this company. I'll use the free cash flow, discounted cash flow, and this is what we have. So what are we doing here? The free cash flow of Google, according to Guru Focus, the past 10 years, it grew at 15.80%. That's how much the cash flow has grown over a 10-year period. Now, there are times over the past 5 years, it was actually higher than that, and it's been really high over the past 1 year. So the question that you have to maybe ask yourself is this, number one, sustainable? Can it grow cash flows at 15.8% going forward? Or maybe is this actually kind of low? Can it do a better job? So if I use this 15.8%, which I might be okay with for Google, can it do it for another 10 years? I would hope so, and I think it can. So as long as I think Google can continue growing its cash flows at 15.8% over the next 10 years, and I give this an 8% discount rate. So the discount rate is a way to look at the discount rate is to say, well, if you want an 8% rate of return on this investment, then you can use an 8% discount rate. There are other ways to look at discount rate, but that's the way we're just going to use on this example. And so all of this combined, what this does is it tells us that the actual fair value of this stock, fair value of Google, according to all the inputs we put here, is $3,030 for a share of Google. Now, this margin of safety here is an important aspect to understand. So Benjamin Graham, who taught Warren Buffett everything he knows, well, not everything. He taught Warren Buffett in his early days. He was his professor. He wrote The Intelligent Investor. So Benjamin Graham's idea of having a margin of safety is a very important part of my investment strategy. So when I find a stock to buy, I don't want to buy it at fair value necessarily. I want to buy it for under fair value because I might be wrong, right? So if I'm wrong by 25%, which is the amount that Benjamin Graham used, then at least I probably won't get hurt too bad. So here we have a margin of safety of 16.22%, meaning that the company should be selling for $3,330 and it's selling at $2,538. There's a margin of safety there of 16.22%. Would I go for Google at 16.2% margin of safety? Generally, I would usually not buy at this margin of safety. I would wait for it to be higher, meaning that I would wait for the stock to go lower. But for the purpose of this video, let's assume that I'm okay with this. We have a good price for Google, but is it a good setup to buy the stock? So this is the point where now I want to go and look at this stock technically. So after zooming in, I know that this was in an uptrend channel for quite a bit of time, but now it has broken down through the trend line, which is this line here. Once it's done that, it is now outside of an uptrend channel. It's no longer trending upwards. It is now trending downwards. So what do I do? Now I want to have a downtrend channel. So now zooming in, we can see that Google is in a downtrend channel. And so the question is, will this continue to stay within this downtrend channel, or will it break out through above the channel at some point in time? So when it comes to finding an entry point to a stock that I like already fundamentally, I take a look first, or not first, but I look at the few following things. So first, the trend. If it is downtrending, I will oftentimes wait to see if it hits resistance in a certain level, And then once it does and there is some type of bounce with potentially another good pattern that's bullish, then I might say that's good. Or I would see if there was consolidation, meaning it stops trending down and it starts trending sideways and not going anywhere really. So after that consolidation phase, for example, if Google were to go down here and continue falling, there's a little area here. This is called a Fibonacci retracement level. So this is a level where I think there could be potential resistance for Google. Now let's just say hypothetically Google hits this and it bounces. Well, a few things can happen. It could bounce and then it could hit another resistance level here, and it could potentially trade sideways, which is also known as consolidating. So it consolidates and it trades sideways for a while. So what I'm looking for is basically a stock that is not in a downtrend channel, which this is in a downtrend, so I don't like that, which means I would not buy Google right now because it might actually fall down far enough for us to actually get to the point where the stock price gives us that 25% margin of safety even. So if I, for example, draw a resistance area here, this would be at around 2004.40. So at 2004.40, and it starts trading outside of this downtrend channel, at that point it's possible that it either consolidates and I wait for it to then break back above another what's called resistance area, which would be above it. And at that point I would say that maybe this is a good buy. Or another way to look at this is I wait until it gets down into my margin of safety area. Then maybe I say, you know what, I don't care if it falls down through further down through this margin of safety area that I have. As long as I hit that 25% margin of safety, I'm happy. So I'm at least hitting a resistance area. I'll take the risk. There's different ways to kind of play this out, but you would kind of wait and see what happens. And right now, of course, I would not buy it because it's sitting in the downtrend. The other things I would do is look at the indicators. So I would look at the moving averages. And as you can see, all 3 moving averages, the 50-day, the 100-day, and the 200-day moving averages are all now above where the stock is selling for, which is not a good thing. They can act as resistance against a stock. So it's harder for a stock to come back up above its moving averages, especially for like a longer term moving average like a 200-day. So that is an indicator that, of course, I also would not be ready to buy the stock. And then I would also take a look at something called the MACD indicator and the RSI indicator. And you can see that here now I have RSI here and I have MACD here. Now the way I look at these is they should be basically confirming what I think. So is MACD and RSI telling me something different than what I already think? So I see a downtrend, I don't like it, but this is telling me that it's actually oversold. As long as it's under this 30 right here, that means in RSI that this is an oversold stock, which means that it could start to turn around. Maybe this is where it starts consolidating. Also, MACD, it's not really telling me yet a signal to start purchasing the stock, and that usually happens when this blue line crosses up over what's called the signal line, which is this red line, and this little oscillator here is where this thing starts to change direction basically. So instead of going down and having bigger bars, it gets smaller and smaller bars, eventually going up, which is when you have a change in direction of the stock price. So the indicators can either confirm what I think or they can go against what I think. So in summary, if I like Google from a fundamental perspective, I would be happy with purchasing Google as long as the actual chart looks good enough for me to purchase Google and liking the entry point as well. So as I've said, Google is in a downtrend channel. It's not time for me to buy it right now, and it potentially could go down further closer to my better margin of safety of 25%, which would be a lot better anyway. So that's it. That's all I have for today. I hope this helped. I hope it was not confusing, but I hope it opened your eyes to kind of the way that I look at investing and how I use both technical analysis and fundamental analysis to balance each other out to try to find entry points into stocks that I think are good fundamentally already. So thanks everyone so much for watching. Hit that like button, subscribe to see future content like this, and watch another one of my videos coming up on the end screen right now.